Hi folks, and welcome back to Meaningful Money. Okay, I'm here above the village of Golville, just outside Penzance. This stretch of land is called the Golden Mile because it's very fertile, as evidenced by the beautiful daffodils behind me. And just over my right shoulder here on the horizon is St Michael's Mount, so we're overlooking Mounts Bay. We're quite high up at this spot. We need to just round off our series on trusts and just look at how you can use trusts to execute some financial planning. Money, remember, is never an end itself. It's just a means to an end, and if we can use trusts to help us achieve our ends, whatever they may be, then so be it. You can set up a trust either while you're living in a lifetime settlement or when you're dead through your will. But remember, the whole purpose of a trust is to enable and to ensure that what you want to happen with your money actually does happen. So, I'm just going to look at two very quick examples of how you can use trusts in your lifetime to achieve a given end. And the purpose of both these kind of trusts is to get money outside of your estate, outside of your control, if you like, so that you can save on inheritance tax when you die. So I'm going to scooch over here a little bit so that I can get some graphics in here. Now, the first of these little angles is called a loan trust. And as the name suggests, the first thing you do is you set up a trust. So you write a trust deed, or you get a lawyer to do that for you, and you loan some money to the trust. And the trustees invest it, usually in an investment bond. But you write into the trust document that you will receive regular repayments, because this is a loan after all. It's usually interest-free, though. So let's say you loan £100,000 to this trust, and you write into the deed that you will receive £5,000 a year repayment for 20 years until all the money is repaid. So that's the arrangement, right? Well, at the end of year one, you've had your first £5,000 in repayment, but let's say that the bond itself has grown by £6,000. Now, markets have gone in your favour, and the bond has increased in value. Well, at the end of year one, you've got a total value of £101,000, and of that, £95,000 of it is still yours to be paid in repayments over the next 19 years. But the top sort of £6,000 is now outside your estate. It's grown and it's outside your estate. It's inside the trust. Now, at the end of year two, let's say the same thing happens. You take another £5,000 repayment and it grows by another £6,000. Well, now you've got £102,000 in the pot. The top £12,000 belongs to the trust. It's outside your estate. The bottom 90 is sort of latent repayments waiting to be repaid to you over the next 18 years now. So you can see what's happening. Assuming the bond grows, and that's a big assumption, is that over time, money goes out of your estate. It stays within the trust. You take some money back out, and the thing grows. And so this is perfect for people who, you've got time for this to work, so perhaps in your 60s or early 70s, but you don't want to give all your money away, or to give some money away even, because this is a loan. You can call it in at any point. So if you need that £100,000 back, or whatever's left of your money in the pot, you can call it back at any point. So the purpose is to get money out of your estate over time. That's a loan trust. Now, the second angle is called a discounted gift trust. Okay, it's a little bit more complex, but it essentially aims to do the same thing. But this has an advantage of getting money outside of your estate immediately. You don't have to wait for it to sort of accrue over time. And what happens here is you set up the trust again, and instead of loaning money to it this time, you make a gift. So let's say you give £100,000 to the trust. You don't need that money anymore. But within the trust agreement, you set up that the trust will pay you an income for the rest of your life. It's subtly different from having repayments, but it's importantly different. It's an income. Now, an income has a capital value, right? If you wanted, for instance, to have £5,000 in income for the rest of your life, and you found a bank account which was going to pay 5%, well, you'd have to put £100,000 in that bank account to get your 5% income every year. Well, the income you're going to arrange from this trust also has a capital value. It depends, though, how old you are, because that will determine how long the income is going to be paid out for. Likewise, your gender, because men die younger than women, as a rule, and also your health. Now, the value of that income will eventually be set if you die within the first 7 years, and I'll tell you why in a minute. So, you just have to take it from me at this point that income that you've set on the trust has a value. So let's say you put 100,000 in, you've arranged to have an income of 5,000 a year out. Let's just say that the value of that income is 50,000, right? It's nice and neat. What you've got now is 100 grand in the pot, and the 100,000 is deemed to be discounted by the value of the income you've arranged. So we've said that's 50,000. So the 100 is discounted by 50. And that discount is deemed to be outside your estate from day one. The remaining £50,000 falls out of your estate over the 7 years, according to the usual rules on inheritance tax. So what you've done is you've got money outside your estate straight away because of this discounting process, because that income that you've arranged has a value. Now, if you die within the first 7 years, the revenue can look back at the arrangement and they will set the value of that discount. If you live longer than 7 years, the discount is irrelevant because all the money's outside of your estate anyway. So the purpose of really looking at these is that just to remind you that money, remember, is never an end in itself. It's there to help you achieve your aims. And you can do that using trust. There's tons of other different angles you can use. And using trust, because they are a separate legal entity and have their own rules pertaining to them, you can achieve your aims very often more easily than you can as an individual. So that wraps up trusts, okay? Any questions as ever, then just leave them in the box below the video, either on Facebook or on YouTube or on the website, wherever, and I'll do my best to answer them. This is episode 99, which means next one is number 100, and that's a big one for me. So I hope you'll join me for that. But for now, thanks very much for watching, and I'll see you next time.